The Federal Reserve just threw a curveball that's about to reshape your entire investment strategy for 2026. While everyone was expecting multiple rate cuts, the Fed held rates steady at 3.5 to 3.75% and signaled only one cut for the entire year. That's not a typo. One cut, not the 3 or 4 the market was pricing in just months ago. If you're sitting in cash waiting for rates to plummet, or if your portfolio is positioned for a dovish Fed, today's announcement changes everything. I'm about to break down exactly what this means for your money and the 3 critical moves you need to make right now. This video is for educational and entertainment purposes only, not financial advice. Always consult a qualified financial advisor before making investment decisions. Let's talk about why this Fed decision is such a big deal and why it happened today. The March 18th FOMC meeting was supposed to be relatively straightforward, but geopolitical chaos changed the script. Oil prices have rocketed above $100 per barrel due to escalating tensions with Iran, and that's sending shockwaves through inflation expectations. The Fed's preferred inflation measure, PCE, has jumped to 2.7%, well above their 2% target. Jerome Powell made it crystal clear they're not cutting rates aggressively while inflation is moving in the wrong direction. Here's what's different this time. Unlike previous oil spikes that were seen as temporary, the Fed is treating this Iran situation as a persistent threat to price stability. The dot plot, which shows where Fed officials expect rates to go, now projects just 1/4 point cut for all of 2026. Compare that to market expectations from January, when traders were betting on 75 to 100 basis points of cuts. That's a massive recalibration, and it means the investment playbook you've been using is about to become obsolete. Let's dig into the numbers that are driving this decision, because understanding the Fed's logic is crucial for positioning your portfolio correctly. First, the oil situation. Crude prices have surged 35% in just 6 weeks, and energy makes up about 7% of the consumer price index. Every $10 increase in oil prices typically adds about 0.2 to 0.3 percentage points to headline inflation. With oil now trading above $100, we're looking at potential headline inflation pushing toward 3.5 to 4% if these prices persist. The Fed learned from the 1970s that you can't ignore energy-driven inflation, even if it starts as a supply shock. Second, the labor market remains incredibly tight. Unemployment is still near historic lows at 3.8%, and wage growth is running at 4.2% annually. That's well above the 3 to 3.5% rate, consistent with 2% inflation. The Fed sees this as evidence that underlying price pressures haven't fully cooled. Third, financial conditions have actually loosened since their last meeting. Stock markets hit new highs, credit spreads tightened, and borrowing conditions improved. From the Fed's perspective, easier financial conditions work against their inflation-fighting efforts. They need some economic restraint to keep price pressures in check, and holding rates higher for longer is their primary tool. Now, here's where it gets interesting for your investment strategy. The market had been pricing in a very different scenario, and that mispricing creates both risks and opportunities. Let's start with the bond market. Treasury yields jumped immediately after the announcement, with the 10-year note moving from 4.1% to 4.4% in a matter of hours. If you've been holding long-duration bonds expecting rates to fall, you just took a hit. But here's the counter-argument some analysts are making. The Fed might be overreacting to what could still be a temporary oil spike. If geopolitical tensions ease and oil prices retreat, inflation could fall faster than the Fed expects, potentially forcing them to cut more aggressively later in the year. However, betting on that scenario is essentially betting against the Fed's explicit guidance, which rarely works out well for investors. The equity market reaction has been mixed but telling. Growth stocks, particularly in technology, sold off hard because higher rates for longer hurt their present value calculations. But energy stocks surged, and defensive sectors like utilities and consumer staples held up well. This rotation tells us everything about where smart money is positioning. The dollar also strengthened significantly, which has implications for international investments and commodities priced in dollars. So, what does this all mean for your actual portfolio? Let me give you 3 concrete action items. First, if you've been sitting in cash earning 5% thinking rates would fall and you'd redeploy later, that strategy is now questionable. With only one rate cut expected, cash rates might only drop to 4.5%, while you're missing out on equity returns and the reinvestment opportunity cost is real. Consider gradually moving some of that cash into dividend-paying stocks or short-duration bonds. Second, sector rotation is critical right now. Energy stocks are obvious beneficiaries of higher oil prices, but don't chase them after they've already run up 15%. Instead, look at energy infrastructure companies that benefit from sustained higher prices without the volatility of exploration and production stocks. Defensive sectors like utilities, healthcare, and consumer staples typically outperform in higher rate environments because their dividend yields become more attractive relative to bonds. Third, reconsider your bond allocation. Long-duration bonds are facing headwinds, but short to intermediate-term bonds now offer attractive yields with less interest rate risk. Consider ladder strategies, or floating-rate securities that can benefit if rates stay higher. For international exposure, the stronger dollar creates opportunities in foreign markets, but currency hedging becomes more important. Here's the bottom line. The Federal Reserve just fundamentally altered the investment landscape for 2026, and adapting quickly gives you a significant advantage. The era of expecting aggressive rate cuts is over, at least for now. Oil-driven inflation concerns and a resilient economy mean higher rates for longer, and your portfolio needs to reflect that reality. Focus on sectors that benefit from this environment, reduce duration risk in your bond holdings, and don't let cash drag down your returns while waiting for rate cuts that might not come. The biggest mistake investors make is fighting the Fed's explicit guidance. They've told us exactly what they're thinking, so position accordingly. If you found this analysis helpful, smash that subscribe button and hit the notification bell. I'll be covering the market's reaction to this Fed decision and diving deeper into specific sector strategies in my next video. Drop a comment below with your biggest portfolio question about navigating this higher rate environment. What sector do you think offers the best opportunity right now? I read every comment, and your questions help shape future content. Thanks for watching, and I'll see you in the next one.